foreign tax credit. We're going to be covering a lot of pieces of the foreign tax credit. And these are generally the pieces that we're going to talk about. Again, as I talk about each one, I'll try to get across why it's there, what it's relevant for. If you don't think I've been clear on it, please ask, because again, unless you see the relevance of something, it's just another rule to forget. So. Okay, so let's think about this a little bit. Why is the foreign tax credit needed? Why do we have that mechanism? Let's just say that a U.S. company has a subsidiary in another country. Now, a U.S. person can have income from this company. This company could pay a dividend. This company could pay interest because maybe the U.S. company has loaned money to it. The U.S. company could license intangible property or rent equipment to the subsidiary. So there's different streams of income that a U.S. person can have. Now, I've drawn this as being a subsidiary, but it doesn't have to be. There are plenty of situations where, for example, maybe General Electric licenses its technology to manufacturers around the world that have no other relationship with GE. GE Financial probably makes loans a lot of times to unrelated persons. So the ownership line is not important. A U.S. company can have streams of income, and when there's a stream of income, other countries are more than overjoyed to tax it. The U.S. has its 30% withholding tax. Other countries have whatever they have. The U.S. rate is one of the highest I've ever seen. Most other countries are much lower, anywhere from 10 to 20%, or even lower sometimes. But the point is that because other countries tax streams of income that U.S. people earn, well, there's a need for some sort of mechanism to, let's say, equalize the field. If a U.S. company does not have a foreign tax credit, cannot reduce its U.S. tax on a dollar-for-dollar basis, then a U.S. company is probably going to want to license technology or loan money or receive dividends from only domestic U.S. companies. They're going to say, we don't want to do that to foreign companies because we get taxed so much. If we don't get a foreign tax credit, it's just going to be too expensive. And what do I mean when I say too expensive? Again, sort of as we've talked before, if there's let's say a royalty, and if there's let's say 20% withholding tax here in this country, and let's say the gross income is 100, and there's a 20% withholding tax, and let's say no foreign tax credit, but there is a deduction. So there's a deduction, let's say, for 20, so our taxable income is 80. And 80 times 35% is 28, I think. So the total tax is 28 plus the 20 withholding, and we end up with a tax rate, an effective tax rate of 48%. Now that, of course, is a terrible answer. And if you were the U.S. company and were looking for, persons to license your technology to, you'd be a lot more active in trying to find domestic licensees as opposed to foreign licensees. So this is one aspect of this, in a sense, need for a foreign tax credit mechanism. Let's mention just philosophically, governments want their own let's say nationally based groups and industries to be successful internationally. If licensing results in such a high effective tax rate, then this is going to be a competitive disadvantage for U.S. companies against other suppliers of technology from other countries where there is a foreign tax credit or where there's no taxation in that country's residency, in the country of residence of that competitor. So the point is, from an international competitive standpoint, you need to have the foreign tax credit there. If it's not there, you're hurting your own national industries. Again, just using some numbers that are in, let's say, used consistently through several slides here. If there is only a deduction for foreign taxes, you're going to end up with an artificially high tax rate. A deduction for a foreign tax, as with any deduction, it's only worth the tax rate times the amount of the deduction. That's the amount of the benefit you get. Your tax is reduced by the tax rate times the amount of the deduction. That's in comparison to in a foreign tax credit where it's a dollar for dollar reduction. So there's a big economic difference when we compare this a foreign tax credit situation where if the foreign tax is equal to or less than the U.S. tax rate, we're going to be limited to a total tax which is no higher than the U.S. rate. Now, in this example, we're assuming that the foreign tax, the actual foreign tax is 25, which is less than 35. In the next example, we assume that the foreign tax is 40, limited under the foreign tax credit limitation formula to 35. which of course zeroes out the U.S. tax. And our effective tax rate is 40. Now notice that in these nice simple examples that the taxpayer's worldwide effective tax rate is the higher of the home country rate or the overseas rate. Now notice we're talking about effective tax rates here. We're not actually talking about statutory rates. Okay, why do I say that? Any ideas? Are all foreign taxes based on net income? Or are they sometimes based on gross income? Yeah, sometimes on gross income. So if we're looking at a withholding tax on gross income, that has no relationship. That's like comparing apples and oranges to a tax rate on net income. Because, gee, it doesn't matter whether, I mean, you might have zero net income because, there wasn't a very successful business venture, or there's inefficiency, and, they're paying too high salaries, or who knows what it is. But the point is, a tax on gross has nothing to do with how much expenses there are. And a statutory rate on net income, it's apples and oranges. I mean, you just can't compare the two. So here, we're looking at really effective tax rate rather, when we make these comparisons. And we're assuming for simplicity that the U.S. statutory rate is also the effective rate, which may or may not be the case, as we might have seen from some of the information about Cisco and other large companies. Now, just as a sort of summary of the concepts that we want to get across. Okay, what do I mean by this host or source country has the first right to tax?
It's where the income is generated, right?
Yeah, where the income is generated. That's a good way to say it. Can the U.S. government do anything to control how much that country where the income is generated? Can anything the U.S. government does affect that? Yeah, no. That's a sovereign country. It does what it wants. And it applies its tax, and the U.S. can do nothing about it. Well, okay, the U.S. could enter into a tax treaty, but that's sort of out of scope for this part of the discussion. So the country of source really has the first bite at the apple, so to speak. And the second one, the point is, the U.S. is unilaterally reducing its tax to the extent that tax has been paid to the other country. So that's rather nice, unilateral. You hear a lot in the news about tax expenditures. This is sort of a tax expenditure. It's a benefit given that reduces U.S. tax. And the U.S. doesn't have to do this. There's no requirement, in international law that says the U.S. has to do this. They unilaterally are doing this.
Is it with all countries, or for example, countries that don't allow the same benefit for income generated?
Good question. It is for all countries with a few exceptions. The few exceptions are things you don't run into very often. And for example, a country that promotes terrorism and is on a certain list, that would be a problem. I believe there's also a reduction for taxes paid to countries that have participated in a boycott, which is focused primarily at, well, let's say the rules came up when there was an Arab boycott of Israel, but the rules are written, of course, much broader than that. So it's those kinds of things where there is, shall we say, no reciprocity. But they're not based on whether that country grants a tax credit. It's based on other characteristics of the country. Now, there are rules, not in the foreign tax credit area, where, yes, reciprocity makes a difference. And the biggest example of that is for aircraft and shipping income. If you look, I want to say, maybe it's 883, there's a reciprocal exemption. In other words, if the other country grants a similar exemption to U.S. shipping, then we will not tax the shipping of that other country, of residents of that other country. So, yeah, reciprocity is something that we occasionally see, but not all that often. Good question. Okay, now notice, again, we'll get into this in more detail, but the foreign tax credit limitation formula limits the credit to the average effective tax rate in the home country as applied to foreign source taxable income. Home country in this case, of course, is the U.S. And the reason for this is that the U.S. wants to protect its tax base. The U.S. wants to protect its tax base. It doesn't want a person who has both domestic income and some foreign income to be able to reduce the tax on the domestic income. And the foreign tax credit mechanism is meant to achieve that. And later on, we'll attempt to look at that in more detail. And again, as I was saying, the total combined tax of the two countries equals the higher of the tax of the country of residence and the host or source country. So these are, basic concepts that you want to keep in mind about the foreign tax credit system.